Happy Friday. Welcome and good morning. Today I'm joined with a guest. She will share more about the fourth pillar of how do you protect your wealth. Once you have invested that money, the fourth pillar is what we are going to talk about today. How do you protect that money from inflation, from conmen? But today we'll focus on life insurance protecting your money. And today we have a guest and she will introduce herself. Karibu sana. Please tell us your name and what you do and specifically life insurance. Karibu.
Thank you so much, Sammy. My name is Josephine.Gachuhi. I am a mother of 3, 2 teenagers and a preteen. I sell life insurance for a company called Prudential Assurance. An international company, a very old company. It's number 4 in the world. So it's quite massive. It's 176 years old. Our work is mainly to just enlighten people and help people to protect what they love most. And I think for anyone, the biggest asset that we have is family first, and then the properties around us and our own health and life.
We chatted with you on Sunday and I shared 10 plus years ago I took a life insurance only for my bubble to be burst that it was not a life insurance, it was an endowment fund. Please share with us what's the difference between life insurance and why should we get a life insurance, and then what did I get? And what's the benefit for that also?
Okay, thank you again. So in life insurance, an endowment policy has a life insurance in it. It's a type of life insurance, but it is an insurance for a specific period of time. That if you took it for 10 years, you only have cover for those 10 years, and then it's more of a savings cover. So if you are saving for those 10 years, if anything happened to your life within those 10 years, and especially demise, your family or the person you named as a beneficiary will be compensated the sum assured. We call it the sum assured. That is the target money that you targeted to save. So like if you needed to save 2 million, the insurance company will tabulate the premium or what you pay per month or per quarter to 2 million by the end of those 2 years. And then if you survive to the maturity date, they will give you back your 2 million plus accrued interest or bonus that accrues within those last 10 years.
Okay, so it's only accessible at my demise as the principal contributor.
Yes, or you can also borrow.
Or you can borrow. But 2 years ago, go ahead.
You can borrow a loan against it, but you will be required to repay that loan back to the insurance company for you to enjoy the full maturity benefit when that maturity date comes. Okay,
but 2 years ago I got a stroke. How come I did not benefit from that cover?
Okay, in this country of ours, Kenya, most of the endowment policies, the way they are structured, they do not have critical illness in the product. Let's say you bought the cover when you are 30 years, this whole of life cover, you buy it for when you are 30 years and you have chosen to pay it in 10 years. That means you will pay the premiums calculated up to age 40, right?
Yeah.
So after age 40, you remain covered for the rest of your life. If God gives you a long life to 90, you will have a cover until age 90. But for critical illness...
So you'll have a cover from age 30 to 40 is when you're paying the premiums. So after age 40, you are not paying premiums, but are you still covered?
Yes, you are still covered, but you will not get any maturity. Now, this whole of life does not have a maturity like you have saved for 10 years. That is not an endowment, okay? So you will stop paying the premium at 40. This is what we call pure protection. So you'll stop paying premium at 40. You don't get any money back at that point, But should you suffer critical illness up to age 65, you will be, if you had a cover for 10 million, like the illustration I gave, and your critical illness benefit is 5 million, you will be given a lump sum of 5 million. Okay?
Okay.
And this 5 million, what we say about this cover, in the short term, an eventuality happening like critical illness or disability or even death, it is an income replacement. You are replacing the income that you used to bring to this home. You are replacing it with the money that the insurance will pay to your beneficiaries, who are your family. And if you get the 5 million, you would have been able to pay for your medical expenses. If you had a medical cover, the medical cover will take care of it. And then the money that you get, it's at your disposal how you want to use it. So that would mean your children will go to the same school, even when you are bedridden, and your family will still be able to afford good meals and the same lifestyle. It's a lifestyle protection, because I believe every day we wake up to give a lifestyle to our families.
Okay.
And then in the long run, God giving you a long time, maybe let's say 80, 90, your children will have grown to their midlife, right? And they will be done with their education. So if God takes you home at that age, then this money that will be paid to your family becomes an inheritance, a liquid inheritance to your family.